the three key nodes. For today, I'd really like to focus in on the part of the definition which says confidence in banks and between banks evaporated. And in order to do that, we can examine the top right part of our systemic interpretation of the financial crisis. Here, we can pull out the following statements about relationships between three key nodes, namely investment banks, the repo market, and special purpose vehicles, or SPVs. These are, firstly, the repo market allowed investment banks to lessen their requirement for long-term funding and asset-to-term funding. Secondly, investment banks were able to package and partially take off balance sheet assets which were placed into special purpose vehicles. Thirdly, the repo market allowed SPVs, or special purpose vehicles, to roll short-term the finance for long-term assets. For some listeners, these might seem pretty arcane, and for others, these are very vanilla statements. For the sake of everyone, I'm going to try to now rewrite these in much plainer English and using non-financial terms. So firstly, banks lent money for long-term projects, such as individuals buying homes, and they themselves borrowed some of this money from a market that only lent it short-term. Secondly, banks were able to take claims relating to the money they had lent for the long-term projects and put them into new pools, allowing the size of these loans to become slightly less visible. Thirdly, as banks used more and more of these new pools, they realised that they had to ask the pools to borrow short-term rather than asking the bank to lend for a longer-term period. So we can begin to see that there is an interplay here between what are assets, what are liabilities, what is borrowing, and who is charged with being the lender. And as well as this, we can see that there's something else happening. There's an interplay allowing for banks to grow their lending much more efficiently as the extent of that lending is partially obscured. And the borrowing to support that lending can easily be accessed in short-term loan format in the repo market. And this can be matched against long-dated loans that the banks themselves have made. This is credit creation, of course, but it's credit creation where the creation of credit is only one of the legs of a stool. The other two legs of that stool are matching short-term borrowing from money markets, which need to be revisited and re-agreed on a very regular basis, against long-term lending, and aligning this with allowing borrowing to grow larger than is initially obvious from a glance at the bank's balance sheets.